Yes, yes. Good evening, dear students. We all. Good evening, students. I welcome you back again to one more exciting session of virtual revisionary session uh, for the subject of financial management, which is again a part of our Group 2 paper 6A, um, financial management. And the topic that we're going to revise today is cost of capital. So cost of capital, it's again an important topic because that goes into the very initial domain of that goes into the very initial domain of um, the relation that we have for raising of funds and investment of funds. Okay, so we need to calculate the cost of capital essentially to know whether a particular investment needs to be done or not, because that's the benchmark which we set as the rate of return that we need, right? So in that, I'll just quickly try to recap some of the formulae that we have in the cost of capital chapter, and then we will go ahead with the questions to discuss about. Okay. So in this cost of capital, what we essentially have is we've got cost of debt, we've got the cost of preference share, and broadly we have got the cost of equity. Cost of debt can be computed as interest into 1 minus T upon net proceeds if it's a irredeemable debt. Whereas if it's a redeemable debt, it's going to be interest into 1 minus T plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. Okay. Cost of preference share, we calculate this as preference dividend plus redemption value minus net proceeds by N. Sorry, if it's a irredeemable one, it's just preference dividend upon net proceeds. Whereas other way around, it's preference dividend plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. Then when it comes to cost of equity, we have got various models for that. First model is constant earnings, wherein we say it is just EPS upon MPS, earnings per share upon market price per share. And we also call it as 1 upon P ratio. Then K is another formula is P1 upon P0, which is just a single dividend that you're going to receive divided by the price. And if you have a growth parameter over there, then we say it is D1 upon P0 plus G. Moreover, the growth rate is B into R. The growth rate is B into R, where B was the retention ratio and R is the return on equity. Another formula that we have for cost of equity is the CAPM model, which is risk-free rate plus beta into RM minus RF, which is the risk premium of the market over risk-free rate, right? And beta is the level of the systematic risk. These are the basic formulae that we have. Apart from that, when we want to calculate the weighted average cost of capital, we simply do it as weight of equity into cost of equity plus weight of debt into cost of debt plus weight of preference share into cost of preference share. Okay, so that's the weighted average cost of capital. Okay, fine. Now, let's go ahead with some practical questions that we have for this topic of cost of capital. Okay, let's have a look at it. Let's look at the first question. It's capital structure of T Limited at 1st April 2024 is as under. So what the capital structure? Equity share capital 50 lakhs, 10% debentures with the face value of 100 amounting to 40 lakh, 12% preference share capital, 10,000 shares of rupees 100 each amounting to 10 lakh. Additional information is risk-free rate of return is 10%, beta of T Limited is 1.75, and return on market portfolio is 12%. Equity shares have a current market price of 70 per share. Equity shares have a current market price of 70 per share. The debentures are trading at a market price of 80 and they can be redeemed. They have to be redeemed after 5 years at par. Preference shares are redeemable after 5 years at a premium of 5% and they're currently trading at 104. The company pays tax at a rate of 30%. An important part they have given us is to calculate the cost of debentures using yield to maturity approach, which is also called as the IRR approach. The present value factors are already given to us at 14% and 10%. That's a hint for us that the PV factor, I mean the cost of capital for debentures is likely to be between 10 and 14%. Let's do it one by one. Let's try to first calculate. I'll do this question. Later on questions, you can definitely take it up. So let's first talk of calculating cost of equity. Okay, so this is cost of equity. Now, can you tell me which model is applicable for this topic of cost of equity? Which model is applicable? Which model am I going to use to calculate the cost of equity? Which model are we going to use for the cost of equity, guys? Can we use the constant earnings, constant dividend, or CAPM? Absolutely CAPM. So when we are calculating cost of equity, what's the risk-free rate of return given to us? Risk-free rate of return is 10%. Beta is 1.75 and the return on market portfolio, so basically RM, is 12%. Okay, so we can get the cost of equity as RF plus beta into RM minus RF. So RF is 10% plus beta is 1.75. RM is 12%. RF is 10%. So what's the cost of equity? 12 minus 10 is 2 into 1.75 plus 10, that's 13.5%. We have cost of equity as 13.5%. Then let's try to solve first cost of preference shares. Cost of preference shares. So cost of preference shares, they are redeemable after 5 years at a premium of 5% and presently selling at 104. So we know the preference dividend. What's the preference dividend payable over here? 12%. The preference dividend is basically 12% of 100, which is rupees 12. Preference dividend is 12% of 100, which is rupees 12. Number of years is 5. Preference dividend is 12% of rupees 100, which is 12. Number of years is going to be 5. Uh, redemption value. What's the redemption value? It's going to be redeemable after 5 years at a premium of 5%. So obviously redemption value is 105. Net proceeds is 104. So redemption value is 105. Net proceeds is 104. Right. So now we have these numbers. We can definitely calculate the cost of preference shares as preference dividend plus redemption value minus net proceeds upon number of years, the whole divided by the redemption value plus net proceeds by 2. Preference dividend is 12 plus redemption value is 105 minus net proceeds is 104. The whole divided by number of years, which is 5. And then we take the average of both, which is 105 plus 104 by 2. So what's the cost of preference share that we have? That's like 105 minus 104 divided by 5, which is 0.2. So plus 12, which is 12.2. That's like 12.2 divided by 104.5. That's 11.67%. Cost of preference share is 11.67%. Okay. So we're done with cost of preference shares. And now we have to do the cost of debentures. Okay. So we have cost of debentures to be computed now. Remember, cost of debentures, they're asking us to calculate using yield to maturity or IRR approach. Now, how do we calculate this using IRR approach? So in IRR approach, we discount all the cash flows of the debentures at a particular rate and try to make it equal to the current market price. So current market price of the debentures, it's 80, right? So I want to make the present value equal to 80. So let's try to write down years and cash flows. So in year 1, 2, 3, 4, 5, I hope tenure is 5 years. Yes, the debentures are having a tenure of 5 years. And what are the cash flow that we are going to get? So 10% debentures, 10% of 100, which is we're going to get a interest of 10 rupee every year. And fifth year, it's going to be the redemption. So that's going to be 110. So we have the cash flows. Let's try to discount it initially at 10% and then at 14%. We'll say present value factor at 10%, and then we take a PV of it. The present value factor at 10% is going to be 0.909, 0.826, 0.751, 0.683, 0.621. Okay, so now we take the PV of it. 10 into 0.909, which is of course 9.09. This 8.26 is 7.51, 6.83, and then finally it is 110 into 0.621, which is 68.31. And then we take a total of all the present values. It's 9.09 plus 8.26 plus 7.51 plus 6.83 plus 68.31. Okay, so they get the present value is equal to 100. But we want to make it equal to, of course, 80. We want to make it equal to 80 because the current market price of the debenture is 80. How do we ensure that it's equal to 80? For that, we'll take present value factor at 14% and then take all the PVs. So 14% is 0.877, 0.769, 0.675, 0.592, 0.519. Okay, so this is 10 into 0.877. It is 8.77. Then you have again 10 into 0.769. So that's 7.69. Then we have 6.75, 5.92. And then we have 110 into 0.519. It is 57.09. Take a total of it, 8.77 plus 7.69 plus 6.75 plus 5.92 plus 57.09. This is 86.22. Okay, so we observe that the present value factors, if you're taking it as 10% it is 100, at 14% it is 86.22. So what should I do? I mean, uh, are we reaching towards 80 rupees? No, we aren't, because even if I made from 10 to 14, it's still 86.22. So let me just take another set of factors as, let's say, PV factor at the rate of 18% now. And then we'll take a PV of it. Okay. So how do we get the present value factor at 18%? So that's 1 divided by 1.18, which is 0.847, then 0.718, then it is 0.609 equal to 0.516 and 0.437. Okay. Then cash flows multiplied by the PV factors, which is 8.47, 7.18, 6.09, 5.16, and then 0.437 into 110 is 48.07. Take a total of it, 8.47 plus 7.18 plus 6.09 plus 5.16 plus 48.07. This is 74.97. Okay, so we got two values. We got two values wise. At 14%, this is 86.22. And then at 18%, it is 74.97. And we actually need the present value equal to 80. We need the present value equal to 80. Right, so 14% and 18%, which is 86.22 and 74.97. So we want that particular rate over here. We want that particular rate over here, which is X%, right? Which is no X% between 86.22 and 74.97. Now, how are we going to get this particular X%? It is quite obvious that the return, that the rate, which is X, that's going to be between 14 and 18. That's definitely going to be between 14 and 18. We want to know what is that percentage. So essentially what we do over here is, I'll just write down the rate and the present value. So at 14%, it is 86.22, and at 18%, it is 74.97. Now, what is the rate that we have? This is plus 4%. Okay, 86.22 minus 74.97. This is 11.25. So plus 4%, rate is like plus 4%, and PV is 11.25. Okay, so plus 4% is the rate. PV is 11.25. Okay. Now, what is the PV that we really want it to be? What is the present value that we want? Like over here, there's a reduction of 11.25. And here, there's an increase of 4%. There's a reduction of 11.25. There's an increase of 4%. So we want to know for this particular reduction, that is from 86.22 to 80, is obviously 6.22 reduction. Right. So this is what we observe, right? Observed change. The change that we observed is when I'm increasing the rate by 4%, the present value is getting reduced by 11.25. When I'm increasing the rate by 4%, the present value is getting reduced by 11.25. If that is the observed change, can you tell me what is the required change? What is the required change? Required change. How much change do we want? We want a change of 6.22 in the present value. And then we want the value of the rate. Right? So we'll talk of required change in the rate. Required change in the rate is obviously going to be obtained by simply cross multiplication. This is minus 6.22 into 4% divided by minus 11.25. 6.22 into 4 divided by 11.25. This is 2.21%. That's the required change. This is the amount of the required change in rate, which is 2.21%. So what is the YTM, or yield to maturity, of debenture? This was 14% plus 2.21%. Because 14% it increases to 18%. That's not the required change we wanted. We wanted a change of just 2.21. Therefore, this is going to be 16.21%. And that's exactly what we want at the cost of debenture. So cost of debenture is 16.21%. Did we all follow this? Did we all follow this? The yield to maturity method, guys. Yep. So we first took at 10%, then at 14%, and then at 18% to check for at what rate we are getting the value of the debenture as 80. Getting this? Yeah. So we got the cost of debentures. cost of debentures. Then we have got this cost of preference share, and also we have the cost of equity. Okay, the cost of debentures, cost of preference share, and cost of equity is calculated. Now we have to go for calculating the weighted average cost of capital. Weighted average cost of capital. Um, for that, we have this book values available. We need to convert the book values to market values. We have to convert these book values to market values and then take the weighted average of that. So let me just write down capital as equity share capital, 10% debentures, 12% preference share, then we have got the book values here. Book values 50 lakhs, 40 lakhs, 10 lakhs, but I cannot take the weightage of these book values. I need to calculate the market value. Let's first get the market values. Equity share capital is 50 lakh. And then you have got 5 lakh into the market price is 70 per share. So 5 lakh into 70, which is going to be like 3 crore 50 lakhs. 3 crore 50 lakhs. 10% debentures. Debentures are trading at 80 rupees, and the count of debentures, since it is 40 lakh and 100 rupees of face value, that's going to be 40,000. 40,000 into 100, which is 40 lakhs. Sorry, not 100. The market price is 80. That is going to be 3 lakh, I mean 32 lakhs. Sorry. And when it comes to preference shares, it's going to be 10,000. 10,000 into 10,000 into what's the market price of the preference share? Preference share is selling at 104. 104 into 10,000. That's going to be 10 lakh 40,000. So we've got the market values. Let's take the total of all the market values. 3 crore 3 lakhs. 3 crore 50 plus 32 lakhs plus 10 lakh 40,000, which is 3 crore 92 lakh 40,000. These are the market values. Then we calculate the weights. These weights are obviously going to be on the basis of the market values. That's 3 crore 50 lakhs divided by 3 crore 92 lakh 40,000. Weightage is 0.8919. 32 lakh divided by 3 crore 92 lakh 40,000. This is 0.0819. 5, 10 lakh 40,000 divided by 3 crore 92 lakh 40,000, which is 0.0265, right? And these are the weightages that we have now. Of course, make it equal. Let me just take this weightage as 0.20. So 0.8920 plus 0.0815 plus 0.0265 comes out to be total as 1. Now what we have to do is simply write down the cost, then multiply weights with cost. Write down the cost and then multiply weights with cost. So cost is what we have computed. Cost of equity is 13.5. Cost of debentures is 16.21. And then the cost of preference share was 11.67. Point 8920 into 13.5%, or you can just say 13.5 into 0.8920, it is 12.042. Then another is 0.0815 into 16.21, 1.32, 1%, 0.0265 into 11.67, that's 0.3093, and then take a total 12.042 plus 1.321 plus 0.3093, that's 13.6723%. Okay, we have got the weighted average cost of capital to be 13.6723%. Okay, do you all get this? Is this problem clear to everyone? Yep. Are we good with it, guys? You will get it, yeah? Okay. We present it in the format that you told me. Yes, definitely. Can present it. There's no harm in it. Okay, that's fine. So we are done with this question number 1 for the cost of capital. Now, let us try to do let's try to solve a similar type of question from your end. Let's say question number 4. It's not same, but I can say it is a bit of similar. You have to calculate weight using the following data by using market value weights. Equity shares 15 lakh, reserves and surplus 5 lakh, preference shares 7 lakh 50, debentures 5 lakh 50. The market prices of these securities are debentures 105, preference shares 115, equity shares is 27. So these are the market prices given. Debentures are having a face value of 100, which are redeemable at a premium of 10%, 10% coupon rate, 4% flotation cost, and 10-year maturity. So over here, the redemption value is 110. 4% flotation cost. Flotation cost means when you're going to issue the debentures today, you need to incur some flotation cost on this. Now, this 4% is going to be of what number? 4% is going to be of what number, guys? Going to be 4% of what? Is it going to be 4% of the face value, or is it going to be 4% of the market price? Yeah, is it going to be 4% of face value or 4% of market value? So you can definitely take over here, since the market price is given, you can take this 4% as a percentage of face value. You can definitely say, since there is no clarity over here, you can take the 4% of the face value. So essentially, you will be able to realize 100 subtracted by 4%. So net proceeds that you're going to get is 96. Then 100 face value per preference division, we have 12% coupon rate, 2% flotation cost, and 10-year maturity. Again, flotation cost. Equity share is having a 4.5 rupee. So this is the amount that we have, 4.5 rupee flotation cost, and market price is 27. So here, when you're calculating the cost of equity, since market price is given and the last dividend is paid, annual growth rate was also given. So we are going to use the Gordon model, or the dividend growth model, in which dividend is going to be 2 rupees and it's going to grow at an annual rate of 9%. Firm has a practice of paying all earnings as a dividend. So we have got the growth rate. We'll be using the dividend discount model, okay, or dividend growth model that we have. Corporate tax rate is 25%. To calculate the overall cost of debt and preference shares, we have to take the average of the respective cost using YTM and approximation method. Okay, we have to take the average of the cost using YTM and the approximation method. So we have to calculate for the cost of debt and preference share using the approximate method also, which is the original formula that we had. Interest plus RV minus NP upon N, right? That you have to compute. And also you have to get uh, the cost of debt and preference share using the YTM method. And then you take the average of both. Okay. So first up, would you like to try this? Yeah, guys. Would you like to try this on your own, or you want me to solve it fully? Yep. You solve it, guys, or you want me to solve? I mean, you first give it a try in a rough format, and then definitely I will, proceed with that aspect. Okay, so once again, let's see over here. Okay, anyways, so in this case, one important update is flotation cost of 4%. Since we have the market price given to us, I need to calculate the flotation cost uh, for net proceeds. So net proceeds will be like I will be issuing the debentures today. So if I issue the debentures of preference shares today, I'm going to have it as 105 today. So that flotation cost is going to be 4% of 105 days. Okay. So let us say this question number 4. We have to calculate the weighted average cost of capital using the data for the market value weights. We have this four no particulars or four uh, type of funds. So we'll first talk of calculating the cost of debt. Okay. So let's talk of calculating cost of debenture. Cost of debenture. So let me write down the initial terms first. What is the amount of interest in case of debentures? So debentures are having a coupon of 10%. So interest is going to be 10. Interest is going to be 10. Then we have the number of years to be 10, right? Redemption value is going to be at a premium of 10%, which is 110. And net proceeds, when we say it's going to be 105 minus 105 into 4%. 105 minus 105 into 4%. Okay. So 105 into 4%, which is 4.2 minus 105, which is 100.8. Interest, N, redemption value, and net proceeds. Okay. Then we have the cost of debt calculation. This is going to be interest into 1 minus tax rate. Do we have the tax rate given to us in the question? Yes, it's 25%. The cost of debt is interest into 1 minus t upon, since we have the redemption thing also, plus the redemption value minus net proceeds upon number of years, the whole divided by redemption value plus net proceeds by 2. We just substitute over here. Interest is 10 into 1 minus tax rate is 0.25 plus the redemption value is 110 minus 100.8 divided by 10. Then the whole thing is divided by 110 plus 100.8 divided by 2. 10 into 0.75, which is 7.5 plus 110 minus 100.8, which is 9.2 divided by 10, the whole divided by 110 plus 100.8, 210 divided by 2, which is 105.4. That's 9.2 divided by 10 plus 7.5 divided by 105.4, which is 7.99%. The cost of debt is 7.99%. Okay. Now this is what we got by using approximate method. So we got the cost of debt by using approximate method. Now let us calculate the cost of debt using IRR method or YTM. So for that, we need to write down the year and the cash flows. We have like year 1, 2, 3, 4. Oh, so we have like total 10 years. If it is 10 years, it's a very long process. We can actually use 1 to 10 and 10th year. So 1 to 10 every year, you're going to get a cash flow of 7.5, which is after tax 7.5. And 10th year, the redemption value is 110. Then you have PV factor and PV. Okay. So now I'm telling you that, let's say, since this is 7.99, let's try to do the PV factor at 8% and then take a PV off. Now, this over here, the PV factor is not going to be a regular one because this is going to be a present value annuity factor because I'm considering present value of all cash flows from year 1 to 10, which is occurring in equal sense, which is 7.5. Present value factor at 8% and the cash flow is going to be 7.5. So you can simply use in the calculator the GT function, or let me just see if I've got over here. Yeah, I've got a memory function also. You can say 1 divided by 1.0, or wait, before that, memory recall, nothing is there. Okay, 1 divided by 1.08. First year m plus, second year equal to m plus, third year equal to m plus, fourth year equal to m plus, fifth year, sixth year, seventh year, eighth year, ninth year, and 10th year. Then we say memory recall, which is 6.71, right? And what was the last value? 1 divided by 1.08. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.46. 463. So we can take the PV, which is 7.5 multiplied by 6.71 is 50.33, and 110 into 0.463, which is 50.9. If we take a total, like into 50.33 plus 50.93, we're getting answer as 101.26. When I'm discounting this at 8%, I'm getting a higher value, which is 101.26, whereas the value that we need is 100.8. So just do one thing. We'll take the PV factor at one notch higher, which is at, let's say, 9%, and then take the PV of it. Present value factor at 9%, and then we do it as a PV. So let me do the memory recall, and I'm just removing it. Memory clear. Okay, so 1 divided by 1.09 equal to m plus. This for the first year, second year, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Then we do the memory recall. This is 6.4177, and the last value was 1 divided by 1.09. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 0.4224. 6.4177 into 7.5. This is 48.1328. The other is 110 into 0.4224. is 46.464. 48.1328 plus 46.464. This is 94.5968. Okay. So we have got these two values, present values, one at 8% and another at 9%. One of them is at 8%, another is at 9%. So calculate the IRR or YTM. Can we do that now? Can we calculate the YTM as we did in the previous case? Yep. Can we calculate it? YTM? Yeah. You just give me the YTM for the debentures, guys. Because I have stated all the numbers for debentures. Try to calculate the YTM for debentures. Give me the YTM by doing the same, and that process is what we call as interpolation. When we do that, please reply, guys. If not, I'll show it again. Shall I solve it? I mean, calculating that YTM by taking the higher percentage and the lower percentage. Yep. Or are you able to do it? Will you be able to solve it and get the YTM numbers? Okay, so somebody has taken 8% and 10%. That's okay. Anyways, there may be some, I don't know, wide, some sort of difference, but that's fine. Okay. So let us say over here we have like two percentages, 8% and 9%. So at 8%, the present value is 101.26. This is 94.59. Okay, 68. And what we want is the value should be equal to the current net proceeds, which is 100.8. And we want that particular percentage over here. Rate and then PV, we observe that at 8%, the PV is 101.26. At 9%, the PV is 94.5968. Okay. So when we increase the rate by 1%, the present value reduced by 101.26 minus 94.5968. The present value reduces by 6.6632. Okay, so we want this to be equal to, this is what we are, what we have observed, right? This is what we have observed change, right? And required change is something that we are looking for. So required change is going to be the difference from this to this. So difference is 101.26 minus 100.8. 0.46 is the amount of change that we need. So of course the rate should be equal to required change in the rate will be 1% into 0.46 divided by 6.6632. 1 into 0.46 divided by 6.6632, which is 0.069. That's the required change in rate. So rate is going to be, basically YTM, or the cost of debt is going to be 8% plus 0.069%. This is 8.069%. That's the YTM, which is 8.069%. What is 8.072? That's absolutely correct. That's fine. So that's the cost of debenture which we have done. Now, same way, we have to do for cost of preference shares. When we're calculating the cost of preference share, we have the information of face value to be 100, redeemable at par, 12% coupon rate. So the preference dividend is going to be rupees 12 and 2% flotation cost. 2% flotation cost. So we have to get the net proceeds as, market price is 115. So from that 115 into 2%, that will be the cost that we need to subtract. So 115 into 2%, which is 2.3 minus 115, which is 112.7. That's the net proceeds. Net proceeds is 112.7. Preference dividend is 12. Net proceeds is 112.7. What's the redemption value? Redemption value. Redeemable at par. So redemption value is 100. Number of years is 10. Okay. So cost of preference share is equal to preference dividend plus redemption value minus net proceeds upon N, the whole divided by RV plus NP by 2. Okay. So cost of preference share is into 12 plus redemption value is 100 minus 112.7 divided by 10, the whole divided by 100 plus 112.7 by 2. Okay. So 100 minus 112.7 is divided by 10, which is minus 1.27. We have like plus 12 to that, which is 10.73 upon 100 plus 112.7 divided by 2, which is 106.35. 10.73 divided by 106.35 is again 10.08%. We got that rate to be 10.08%. Now, this is obviously the approximate rate. So, by the way, this is not the cost of data because they have stated to be taking the average. So, one of the number was 7.99, other we got it as 8.069. So, the cost of debt is going to be 8.069 plus 7.99, the whole divided by 2. 8.069 plus 7.99 divided by 2, which is 8.03%. The cost of debt on an average basis. Same way you have to get over here the cost of preference share. So here we say year cash flow. So in year 1 to 10, you have a preference dividend of 10. And then from year and in the 10th year, you have the redemption value to be 100. So first, you take the present value factor at 10% and give me the PV, right? And then we'll see what is to be done. First, give me the present value factor at 10%. I mean, just give me the PV value. Just give me the PV value. If this question comes in exam, how much time it should take to solve in full? This will be a 10-mark questions. You can expect it to be solved within 20 minutes. Okay. Yeah. So give me the present value as quickly. Obviously, right now will take more of time because we are discussing and solving it. But when you do it in isolation, you'll be able to solve it at a much faster pace. So give me the present value at the rate of 10%. Miss. Give me the present value number is 10%. The PV factors will be 1 divided by 1.1. The memory recall. Okay. 1 divided by 1.1 equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We have the PV factor as 6.144, or let me just write it as 6.14. 1 divided by 1.1. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, this is 0.3855. 12 into 6.14, which is 73.68. And this is 38.55. So if you take a total, that's 73.68 plus 38.55 is 102.23. Net proceeds, we want to match the net proceeds with 112.7 and we got 112.23. So still we need to, increase this. Right, I have to increase it from 112.23 to 112.7. So I need to decrease the rate of discounting. So I'll take the present value factor at 9% and take the PV of it. This is 1, sorry, memory recall, memory is clear. 1 divided by 1.09. 1.09. This is 1 year, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.3891 to the MRC. That's 6.2. Then we take the present value, which is 6.2 into 12, 74.4, and 100 into this 38.91. 74.40 plus 39.91. 74.4 plus 39.91, which is 114.31. Now we do the interpolation between them. So at 10% we had 112.23. Then at 9% we have 114.31. This is the rate, this value is something that we want as 112.7. We want the rate. So percentage, we're looking at the rate and PV. So rate is at 10%, it was 112.23. And at 9%, it is 114.31. This is like minus 1% and 112.23 minus 114.31. So there's a increase. So PV is increased by 2.08. Now, of course, the rate that we wanted, the value that we wanted is 112.7. So 112.7 minus 112.23, which is 0.47. We wanted to change it by 0.47. So what will be the rate? Change in rate. That's 0.47 into 1% divided by 2.08. This is 0.47 into 1 divided by 2.08 is 0.2259. So what is the YTM that we have? That's going to be 10% minus 0.2259. 10% minus 9.7741%. And finally, we can say that cost of preference shares is 9.7741 plus the approximate method, which was 10.08, the whole divided by 2. 9.7741 plus 10.08 divided by 2 is 9.927%. Okay, so we got the cost of preference shares, guys. We've done with cost of debentures, we've done with cost of preference share. Now equity shares. Coming to the equity shares part. Cost of equity. We calculate the cost of equity. Cost of equity is going to be K is equal to D1 upon P0 minus flotation cost. We're going to subtract the flotation cost over here plus the growth rate. So we have D1 as last dividend that was paid was 2 and is expected to grow at 9%. So the dividend is definitely going to be 9% addition to the previous year dividend, which is 2 into 1.09 divided by P0 is current market price of the share is 27 minus 4.5 plus growth is 9%, 0.09. This is going to be 2 into 1.09, 2.18 divided by 27 minus 4.5, which is 22.5 plus 0.09. That's 2.18 divided by 22.5 plus 0.09. That's 18.69%. Then finally, we have the calculation of weighted average cost of capital. Now to calculate the weighted average cost of capital, we'll write down the capital amount. We'll talk of the market value, right? Do some calculations, get the market value, weights, cost, and then weights into cost. Okay. So now we've got the capital as three types. We'll talk of equity because reserves we are not going to consider separately. Reserves will be included in the equity itself. Then we have the preference capital and the debentures. So market value is 105. Well, debentures, sorry, equity is having a price of 27. So 27 into 1,50,000. So market value is 40,50,000. Preference shares are having a market price of current market price of preference is 115, right? So 115 into 7,500, which is 8,62,500. Debentures are redeemable at a premium of 10%, 10% coupon rate, 4% flotation cost. Premium of 10% and 4% flotation cost. So debentures market price is 105. So 105 into debentures count is 5,500. So this works out to be 5,77,500. So total, this is 54,90,000. I can get the weights as 0.7377, 0.1571, and 0.105. So these are the weights which will obviously totaling up to 1. The cost of equity which we have got 18.69%. Cost of preference share, we got it as 9.927, 9.92. And cost of debentures, we've got the cost of debentures to be 8.03%. And when you do the weighted average of the weights and the cost, get the answer as 16.22%. Weighted average cost of capital stands as 16.22%. Okay, so there's a solution for the next question. So wherein it was similar, but even in preference share, we were trying to get the YTM method. Okay, it's fine. So with that, let's just take a break right now, guys. So we've done a couple of questions. We have three more to go. So maybe two of them will be definitely be able to do it, and one I will expect you to be solving it. So let's take a break now. We'll meet back at around what at 7:20. So by 7:30 we should be meeting back again. Okay, take a break, guys. Okay, welcome back, guys. Shall we continue? Are we all there? Hmm. We have completed question one and question number four. Now, let us look at the question number two. Yeah, question number two. RAM Limited evaluates all its capital projects using discounting rate of 16%. Its capital structure consists of equity share capital, retained earnings, bank term loan, and debentures redeemable at par. So we evaluate all the capital which is discounted of 16%. Capital structure is consisting of equity share capital, retained earnings, bank term loan, and debentures which are redeemable at par. The rate of interest on bank term loan is 1.4 times that of debenture. Remaining tenure of debenture and bank loan is 4 years and 6 years respectively. Book value of equity share capital, retained earnings, and bank loan is 20 lakh, 30 lakh, and 20 lakh respectively. Debentures which are having a book value of 30 lakh are currently trading at 98, and ongoing P multiple for the shares of the company stands as 4. Okay, you're required to calculate the rate of interest on bank loan, rate of interest on debentures, and tax rate applicable is 30%. So it's a very interesting question. So what we have right now as numbers is, since we evaluate all the capital projects using a discounting rate of 16%. So what is this 16%? This is KO. So we have the information given to us as KO is 16%. Then rate of interest on bank term loan is 1.4 times that of debenture, and remaining tenure of debenture and bank loan is 4 years and 6 years respectively. Book values are given to us, and debentures which are having a book value of 30 lakh are currently trading at 98, and ongoing P ratio is given. So obviously we have to calculate the weighted average cost of capital using the market value weights. So let me write down the capital, amount, which is the book value. Then we have the market value. Then we have the weights, cost, and weights into cost. So capital is, we have equity, then we have the debentures, and bank loan. Okay. So we have to calculate the amounts. The book values are given. The book values of equity share capital, retained earnings. Actually, we have got the retained earnings also. So I need to write over here the retained earnings also. So equity amount is 30 lakh. Retained earnings, no, sorry, equity is 20 lakhs. Equity, retained earnings, equity is 20 lakhs. Retained earnings is 30 lakhs. Debentures are bank loan is 20 lakhs. And debentures are having a book value of 30 lakhs. Now, we need to have the market price per share. Equity, we don't know what's the market price. Retained earnings, obviously, market price is not applicable. For debentures, are having a current book value of 98. And of course, when it comes to the bank loan, 30 lakh will be taken as the market value because there's no separate market value that we have for the uh, there's some issue about book value of equity, retained earnings, and bank loan. Equity, retained earnings, and bank loan are 30, 30 and 20. Okay, so this is 20. Bank loan is 20. Debentures are having a book value of 30 lakh. Debentures are having a book value of 30 lakh. It is currently trading at 98. So we can get the market value of debentures as is 98 multiplied by 30 lakh. So 30,000, 29 lakh, 40,000 is the market value. Here we don't take any market value for retained earnings, but yes, for equity, I need to use the P ratio to get the price and then get the weights, right? So this is going to be maybe by some working note, which will do it uh, below. Now, do we have the tax rate given to us? Yes, tax rate is 30%. So we need to know that the rate of interest on debentures and that of bank loan is going to be computed, and the final weights into cost. This number stands as 16%. Weights into cost stands as 16%. I need to have the cost values available with us. So, and also the weights. So for that, I need to take the total of market values also. We have to calculate the rate of interest on bank loan and the rate of interest on debentures. Okay, so rate of interest on bank loan and rate of interest on debentures. Okay, now how do we go about this rate of interest on bank loan and debentures? Because obviously there has to be some sort of reverse calculation. So we will have to definitely take in on an assumption. We will say let rate of interest on debenture is equal to X. So therefore, rate of interest on bank loan is 1.4x. Rate of interest on debentures is X. Rate of interest on bank loan is 1.4x. Right? So rate of interest on debentures is X. Bank loan is 1.4x. You can definitely get the cost also, right? So cost of debt will be interest into 1 minus t plus RV minus NP by N, the whole divided by RV plus NP by 2. Interest into 1 minus t is basically cost of, interest on debt is anyways X. So X into face value. So let's take it as, just X, the interest rate. So interest is X. Then X into 1 minus, or I can say this is, since this rate of interest is X, so we'll take it as X upon 100. Or let me take it as X into 100. Yeah. So 100X into 1 minus tax rate is 0.3 plus RV minus NP by N. So redemption value, debentures are obviously not stated anything. So debentures redemption value is definitely going to be 100 minus 98, which is 2, divided by number of years is, remaining tenure of debenture is 4 upon, going to be 100 plus 98 by 2. The cost of debt is going to be 70x plus 0.5 upon 99. 70x plus 0.5 upon 99, and this is going to be equal to, what are we really doing? This is going to be in decimal only, right? So 70x upon 99. So 70 divided by 99 is 0.707071 x plus 0.5 divided by 99, 0.005051. Okay. So this is the cost of debt that we have. Zero point 7070, or let me take it as 0.71x. Let me take it a 2 decimal. 0.71x, 0.71x plus 0.005051. This is the cost of debentures. Okay, cost of debentures. Bank loan is going to have a cost of, since it is 1.4x. So like cost of debt of bank loan, cost of debt of bank loan, how 100x, because 100 is the face value, right? So therefore we take that as 100x. Okay. Okay. So yeah, cost of debt of bank is going to be, this is having the interest of X, right? So if this is the bank loan is having a interest, we can say interest into 1 minus t. So interest is 1.4x into 1 minus 0.3. 1.4 into 0.7, which is 0.98x. So we have got the interest, I mean the cost of debt to be 0 point, and bank loan it is 0.98x. Okay. Then we have got like, we don't know what's the is there any way by which we can calculate a market price of equity share? Because if we can get that, we can definitely get the weighted average. We just have the number that P multiple is 4. Okay. So since P multiple is 4, to get the price, we need the value of earnings. Now, for earnings, we don't have any other number available as such. We don't have any other information for that earnings. So I cannot calculate the market value. So we'll have to exclude this from our calculation. Had it been some information given to us regarding the earnings or anything like that, we would have taken it. But since we don't have any information of earnings, we'll have to exclude that part and simply go ahead with a weightage. Okay, so weightage, this is going to be 1 crore. Weightage is going to be 0.2, 0.3, 0.3, and 0.2. Okay, so weights are going to be like this, and we have got the cost of debt, cost of bank loan, retained earnings, and the cost of equity is going to be same. We just have information for cost of equity that the shares are trading at a PE of 4. Now, since we have the value of PE, the cost can be computed. I mean, the cost of equity will be, cost of equity is 1 upon PE ratio, which is 1 upon PE of 4, which is 0.25. So PE of 4, so cost is 0.25. Right now, we have to take the value of weights into cost and take the total is equal to 16%. So weights into cost is 0.25 into 0.2, which is 0.05. This is 0.075, and this is going to be 0.71 into 3, which is 2.13x, plus 0.3 into 0.005051, 0.001515, 0.2 into 0.98, 0.196x. Of course, the total of all of that is going to be equal to 16%. If we just take a total of all of it, what are we going to get? 0.050 into 0.25. Why are we doing it? 0.050 plus 0.075 plus 0.001515 plus, not plus, just say it's equal to 0.25303. No, that's a mistake. 0.050 plus 0.075, 0.05 plus 0.075 plus 0.001515. Is 0.1265 plus 2.13 plus 0.196 is 2.326x, right? And this is going to be equal to 16%. 0.1265 plus 2.326x is equal to 0.16 because at the 16% rate. 0.16 minus 0.1265. We have that as 0.0335. So x value is going to be this divided by 2.326. X value is what? 1 point. No, there's some mistake. 0.0335. There is some mistake, I suppose. This is 0.05, this is 0.075. Then this 0.196x. This is something which is going wrong, I think. 0.7, well, it's not 2.13, my bad. Because this will be 0.3 into 0.71. 0.3 into 0.71 is 0.213 and 0.005051 into 0.3, which is 0.001515. Okay, so this is going to be equal to 0.050 plus 0.075 plus 0.001515. 1265, that's perfect, but this is going to be 0.213 plus 0.196, 0.409x. Yeah, so this is 0.409x is 0.16. 0.16 minus 0.1265, and then this is divided by 0.409. So x is 8.19%. Yeah, the value of x is 8.19%, which means cost of debt for debentures, it is 8.19%, and cost of debt for bank loan is 8.19% into 1.4. 8.19 into 1.4, which is 11.47. Okay. That's how we get the value of x. Okay, so interesting as well as quite a bit different question that we can think of. Now coming to question number 3. As a financial analyst of large electronics company, you are required to determine the weighted average cost of capital of company using book value weights and market value weights. The following information is available for your perusal. The company's present book value capital structure is 8 lakh, 2 lakh, and 10 lakh of debentures, preference share, and equity. All securities are traded in the market, and recent prices are given to us. Anticipated external financing 100 per debenture redeemable at par, 10-year maturity, 11% coupon rate, 4% flotation cost. Sale price is 100. 100 preference share redeemable at par, 10-year maturity, 12% dividend rate, 5% flotation cost. Sale price is 100. And equity shares are also given. In addition, the dividend expected on equity share at the end of the year is 2 per share. The anticipated growth rate in dividend is 7%. Firm has a practice doing all its earning, and corporate tax rate is 35%. You have to calculate the book value using market values. Cost of capital using book value and market value weights. You have to calculate the cost of capital using book value and market value weights. Okay. Get the so for that we need to get the individually costs, cost of debenture, cost of preferential. We can use the approximate method. So I would like you to probably solve this, and for that we can definitely put up a timer. This is something which is easily doable. Let me just put up a timer for 8 minutes are sufficient. Yes. Here we have this question number three. And timer is running. Yeah, let me just cancel it and start again. So we've got 8 minutes to solve this question number three, guys. Try to solve it quickly. Okay. So here we have third question. Let me just ask you simple numbers for this. Tell me, what's the cost of debt that you're getting? Cost of debt. Cost of debt, basically your debenture. Cost of debt is going to be 11 rupee interest into 1 minus 0.35, which is 1 minus tax rate, plus 100 minus 4% flotation cost, because it's currently trading at 100. So 96 is the net proceeds upon 10, the whole divided by 100 plus 96 by 2. This is going to be equal to 11 into 0.65, 7.15 plus 0.4 divided by 98. This is 7.704%. Okay. Then cost of preference shares. This is going to be preference dividend. So preference dividend is 12% dividend rate. So which is 12 plus redemption value is 100 minus 5% flotation cost. So it's obviously 95 upon 10 years. The whole divided by 100 plus 95 by 2. 100 minus 95 by 10, which is 0.5 plus 12. 12.5 divided by 97.5, which is 12.82%. And cost of equity is D1 upon P0 plus G. D1 is the dividend expected on equity share. The dividend expected, there's no need to add growth. 2 upon price is going to be 22 minus 2, which is 20, plus growth rate is 7%, 0.07. So this is going to be like 17%. Okay, so we got the uh, cost of capital. Now we have to get the weighted average cost using the book value and the market value. Okay. What's the use of sale price? Sale price is used to determine this net proceeds, right? After subtracting the flotation cost, right? Then we have the capital, book value, cost, and obviously from book value you can get the weights, cost, and then it's going to be weights into cost. So debenture, preference share, and equity share. Debentures are having a book value of 8 lakh, preference share is 2 lakh, and equity share is 10 lakh. Weightage is like 0.4, 0.1, and 0.5. Costs are, debentures are having a cost of 7.7. This is 12.82. And equity shares are 17%. When you do the weights into cost, this will work out to be 12 point, no, sorry. Overall cost of capital is going to be, yeah, 12.86%. Rotation cost should be percentage of current value. But here they are saying clearly, right, sale price. If you're going to sell the securities now, you're going to fetch this much. Current price is TK. Current price is 110, 120, and 22. That's the current market price. But if you're going to sell the debentures, you're going to issue the debentures today, you will receive 100. Therefore, we are considering the sale price. Okay. Now, this was with regards to book value. Now, when it comes to market value, we're going to have like capital, book value, weights, cost, then weights into cost. We have like debenture, preference share, equity share. I mean, instead of book value, I need to write down the market value. So debentures are having a market value of 110. So 110 into 8,000, right? So market value will be 8 lakh 80,000. Preference share, again, it's got a market price of 120. So that's going to be 2 lakh 40. 2 lakh 40. Then equity shares of 10 lakh. Equity shares of 10 lakh. And then 22 is the price. So 22 means it's going to be 22 lakhs. Right. So total is going to be 33 lakh 20,000. You can get the weights on these lines. 8 lakh 80,000 divided by 33 lakh 20,000, which is 0.2651. 2 lakh 40,000 divided by 33 lakh 20,000, which is 0.0723. 2 lakh 20,000 divided by 33 lakh 20,000, which will be 0.0663. Then the cost is 7.7%, 12.82%, 17%, and then you take the weighted average. So under this, weighted average is 14.23%. You get it? Yeah, fine. So that was question number 3. 4 is already done. So we are left with just one more question, which is question number 5. Question number 5. So for that, again, I'm going to give you timer of 8 minutes. Let's start this. That's the last question that we have. So question number 5. Try to solve it. Okay. So cost of equity will be 10% and cost of debt will be simply after tax interest rate because there's no redemption value or anything. So we have the equity capital amount as 10 lakh, preference share capital as 15 lakh, debentures is 15 lakhs, right? And the total is 40 lakh. So weights are going to be like 0.25. This is 0.375, 0.375. Cost is 10, 12, 6.5, and then weights into cost. So that should be 9.43. Okay, that's the first thing. Then there are certain changes that are happening which are raising that we're going to recalculate the WACC if the company raises an additional 5 lakh of debt by issuing 12% debentures. This change is going to result in an increase in the expected equity dividend to rupees 7 per share, while the growth rate remains constant at 5%. A decrease in market price of equity shares is going to be to 90%. Okay. So the change that we are going to have now is a revised calculated cost of equity, revised weighted average cost of capital. Revised K is equal to 7 upon 90 plus the growth rate. So this is 12.78%. And the new cost of debt, because you're going to issue 5 lakh of debt by 12%. Okay. So that cost of debt is going to be calculated as what's the rate of interest? Rate of interest is 12%. So after tax, we can make it as 12 into 1 minus 0.3. So that is going to be 12 into 0.7, which is 8.4%. Sorry, what's the tax rate over there? 35%, my bad. Tax rate is 35%. So 12 into 0.65, which is 7.8%. So K is 12.78 and KD is 7.8%. So revised WACC, we can essentially get it by taking this as capital, as equity share capital, preference share capital, debentures. And there are two sort of debentures. One is 10%, another is 12% debentures. We have the amount, we have the weights, cost, and then weights into cost. Amount is 10 lakh, 15 lakh, 15 lakh, and 12% debentures is 5 lakh. This totals to 45 lakh. Calculate the weights and simply take the cost. So weighted average number is going to be 9.867%. Okay. So that's it. We are done with all the questions on the handout of the cost of capital. I hope we're able to revise almost all the concepts that are relevant in this particular chapter of cost of capital. So we've been cost of equity, cost of debt, cost of preference share, weighted average cost, any additional cost. All that we have covered, and I think we are good to stop for the day. Okay. Thank you guys for attending the session, and I hope wish you all the best for your exams. Thank you guys. Let's stop here. Bye bye. Yeah.